I just finished wading through, well, wading is the right word, hundreds of pages of the annual report you sent
Like
over.
a lot, I know.
When an institution with this kind of systemic weight issues its yearly recap, it's not just a financial statement, it's a roadmap for an entire economy. And it is exceptionally dense, designed to overwhelm, frankly.
That's the nature of these massive disclosures, right?
Right.
This 2024 annual report for the bank conglomerate is its unique source.
More than just numbers.
Oh, way beyond just the financial figures.
Hmm.
It details these complex, forward-looking commitments across ESG, that's environmental, social, and governance, and it reveals these monumental tech investments.
So our mission today is to cut through all that noise and give you, the listener, the ultimate shortcut.
Yeah, the high-impact facts.
Exactly.
Yeah.
We want you to have a crystal clear understanding of where this gigantic institution is focusing its resources and, specifically how it's trying to juggle its massive financial goals with some genuinely ambitious social and environmental targets.
And we should probably start with the one metric that just, defines the sheer scale we're talking about. In 2024, the bank's total credit portfolio,
The one they call Ampliata.
right, the expanded portfolio, which includes everything, loans, securities, all of it, it surpassed $1,278 billion.
Which is a staggering number on its own.
It is. And it represents a 15.3% growth year over year.
Okay, let's unpack this.
Yeah.
That trillion-plus number really sets the tone. So starting with the core financial results.
The adjusted net income for 2024 hit $37.9 billion, a solid 6.6% increase.
That's steady, right? Performance-driven growth. But for me, the number that really jumps out is the growth in something less tangible.
You're talking about the brand value.
Yes, the report highlights that the bank's brand value soared to $47.8 billion. That's, what was it, a 95% growth.
A 95% growth in a single year.
Yeah.
It's incredible. And that figure isn't just, a marketing puff piece. It speaks volumes about market perception.
It has to.
When a brand value nearly doubles like that, it signals this deep foundational confidence. It's likely coming from their digital transformation and, well, the stability that comes with their unique public-private status.
And that stability and reach are key. They still have a huge physical footprint, 51,791 service points across the country.
Agencies, electronic posts, the works. It's a massive legacy network.
Yet the real strategic pivot is clearly digital.
Absolutely. The analog world it's almost obsolete for them. The report specifies that 93.8% of all transactions now flow through digital channels.
Nearly 94%. That's amazing.
It is, and that's why you see over 22.2 million clients logging into their main app every single month. They've effectively turned that sprawling physical infrastructure into a dynamic digital ecosystem.
And it's so vital to remember, as we analyze this, that this isn't a purely private company. That context changes everything, doesn't it?
It's the critical piece of the puzzle. This institution is majority controlled by the federal government, a 50% ownership stake.
Which means it's operating under really strict oversight.
Extremely strict. From bodies like the CVM and Basin, the central bank, it puts them right at the intersection of public policy and top-tier financial performance. They're a commercial engine, but they're also a policy tool.
Right, and they leverage that scale on the world stage, too. They have 8 dependencies in 7 countries: Frankfurt, London, Tokyo, Shanghai.
Plus major subsidiaries like Banco Patagonia and BB Americas. So this isn't just about domestic policy, it's a global financial player.
Okay, so they're moving over $1 trillion. The big question is, how do they make sure that capital is deployed responsibly? And that brings us to the E environment and its biggest driver, agribusiness.
Yeah, this is where it gets really interesting. They are the undisputed leader in that sector.
By how much?
The bank is responsible for a phenomenal 41% of the total volume dispersed to the national agro sector. The portfolio hit $397 billion in 2024.
That's free. Lending nearly $400 billion to agriculture sounds like a massive exposure to climate risk, to weather events.
It is a huge exposure. And that's precisely why their risk tools are so sophisticated. They mitigate this with advanced climate intelligence.
What does that actually mean? What are they using?
They leverage tools like ZARC, the Agricultural Climate Risk Zoning System, and RTA. These aren't just weather apps, they are geospatial intelligence platforms. They monitor climate impact across more than 95,000 credit operations.
So the financing is actually conditional on using this data.
Exactly. They use georeferencing to ensure the finance properties comply with environmental law, so that they're not in restricted areas. It's groundbreaking stuff.
Okay, so zooming out from agro, let's look at the broader sustainable credit portfolio, the CCS.
That portfolio hit 386.7 billion, a big 12.7% increase. And crucially, the report points out that most of this is rated A for high socio-environmental additionality.
Which is jargon for.
It basically means they're not just lending to any green project. They're focused on projects where their financing creates a measurable positive impact that wouldn't have happened otherwise.
They're also reinforcing that commitment externally. They issued, what, 750 million in international bonds for these kinds of projects?
They did. And internally, their own goals are concrete. A 42% reduction in Scope 1 emissions by 2030, and they already compensate 100% of their direct emissions.
And we saw this in action, right? During the floods in Rio Grande do Sul.
We did. Their response wasn't just charity. They flexibilized credit for farmers, and the foundation contributed 50 million for reconstruction. It shows that policy influence in action.
All right, let's shift gears. Let's talk about how the bank actually serves its millions of customers, especially small businesses. What are the big aha moments in their tech strategy?
The commitment is quantified. They invested 8.5 billion in technology in 2024 alone. And that money is heavily focused on AI, on open finance, and on their own digital platforms.
And of all the tech they detailed, the one that really stood out to me was the Solução Imediata, or SIM. It just turns the whole customer dispute model on its head.
It's a huge differentiator.
Hmm.
SIM uses AI to automatically approve reimbursements up to 1,500 for customer complaints.
Like glitches or minor fraud incidents.
Right. The policy is effectively pay first, investigate later. They use natural language processing to analyze the complaint and just release the funds.
Which sounds like a PR dream.
Oh.
But what about the cost? Does the report say anything about the fraud rate or the write-offs from this? I mean, is this really sustainable?
That's the key question. The report emphasizes the qualitative benefit, customer loyalty, reduced complaint time, but it's less transparent on the exact write-off costs.
So they're betting on loyalty.
They are. They're betting that instant resolution reduces customer churn so much that it outweighs the marginal fraud risk.
They're also using AI for compliance, which is usually a huge point of friction in banking.
Correct. Their compliance digital tool uses AI and OCR to validate, I think it was 134,000 fiscal documents. It cut processing time by 20% and helps mitigate internal fraud risks.
And we have to talk about PIX, the instant payment system. It's just redefined the entire financial landscape.
It's been a revolution for financial inclusion. The bank processed over 6.7 billion PIX transactions last year.
Moving how much money?
Over 5.3 trillion. A 43% increase in volume in a single year. And the report highlights how PIX helped bring something like 60 million previously unbanked citizens into the financial system.
And that trust in their digital systems, you see it in their open finance numbers. 2.28 million clients signed up.
And 81% of them chose indefinite adhesion. That shows huge trust in how the bank is managing their shared data.
And what about for small businesses?
For them, they've built a tool called the Panel PGA platform. It's a beyond banking solution. It supports 211,000 clients, helps them consolidate financial data from multiple banks, and just manage their operations.
So we've covered the financial muscle and the tech engine. Let's look at the S pillar social. The bank is actively engaging in some very specific social targeting.
The diversity, equity, and inclusion commitments are explicit and they're numerically targeted, which is what you need for real accountability.
What are the targets?
They're aiming for 30% women in STEM roles by 2030 and a more near-term target of 30% Black or Indigenous people in leadership by 2025. These are serious public commitments.
They also heavily support women entrepreneurs, don't they?
They do. Over 1.3 million women-led businesses are clients, which is 42% of their customer base. And in 2024, they dispersed 1.5 billion through credit lines designed specifically for them.
And beyond business, I thought their efforts for vulnerable populations were really striking, like the first credit card in Braille.
That's a powerful symbol.
Mm.
But they're also using AI to identify and personalize service for illiterate clients to make sure they get the right support. And they launched a specific policy for financial education this year.
To help with over-indebtedness.
Exactly. To help clients build financial health, not just to lend them more money.
We've covered the E and the S. The final pillar is G, governance, which has to be paramount for an institution this size, especially with government ownership.
Absolutely. The report details a really robust framework to balance public interest with their fiduciary duties. Governance is how they manage the conflicts in that dual role.
Right, and it allows them to use tools like the compliance digital we mentioned.
Precisely. to prevent fraud, ensure transparency, and adhere to anti-corruption laws.
Yeah.
And because of their global reach, Frankfurt, London, Shanghai, their internal systems have to meet the strictest international standards, not just domestic ones.
Okay, let's close out with a surprising and I think crucial internal governance detail we found: the data on their own workforce's health.
Yes, this is a really important insight. It reveals a significant tension inside this highly efficient machine. The data shows the primary health risks among staff are ergonomic issues and, most notably, psychosocial risk.
Which means mental workload, stress.
Exactly. And the direct consequence is measurable. Total days lost to health-related absences increased significantly. It was 883,939 days in 2024.
That's a huge number.
It is. And to mitigate this, they're offering extensive support, like free online therapy sessions. And the engagement is massive, 87,000 consultations last year. But the rising absenteeism shows the foundational stress is a profound challenge.
So to synthesize this deep dive, we saw an institution with massive financial scale over 1.278 trillion in credit. They're a tech protagonist, pioneering AI for customer service and moving 5.3 trillion with picks.
And crucially, they've embedded ESG deep into their strategy. They're a leader in agrotech using geospatial data for climate risk, and all of it is governed by this complex public-private structure.
The ultimate insight for you, the listener, is that this modern financial giant operates simultaneously as a commercial engine, a tech developer, a climate assessor, and a social welfare provider. It's a performance-driven system tied to huge societal goals.
A truly integrated machine.
Yeah.
But as we just noted, not without its internal costs.
And that leads us back to that paradox we uncovered, the internal stress on their employees. We saw that even this major corporation, which is investing heavily in employee well-being, offering nearly 90,000 therapy sessions, still reports a significant increase in days lost to health issues, especially from that mental workload.
The more efficient the system, the higher the human demands.
So if an institution this sophisticated and this resourced struggles to mitigate the increase in foundational stress for its workforce, what does that tell us about the structural pressures of the modern professional environment, regardless of the industry? Where does the ultimate responsibility for a truly healthy work environment actually lie when the demands for efficiency keep outpacing the resources for relief? Something for you to mull over.
A question that is only growing in relevance.
That's it for this deep dive.